Brad Williams, Frugal Finance, financial performance metrics every investor should know. I'll try to keep this short and sweet and to the point. This information will be posted below. Evaluating a public company's financial performance can be complicated. There are several distinct performance measures within a company's income statement, each telling a different part of the story. I'm hoping you understand what an income statement is, a balance sheet, and the cash flow statement. If not, take a look at my various videos under investing. I'll have specific videos on each of those. You'll likely come across these measures as you research stock online or read a company's latest earnings report. Understanding them can help you determine how well a company is performing over time and how its valuation compares with industry peers. Here are some financial terms that should be part of every stock investor's vocabulary. The net income, perhaps the most basic profit measure. Net income, what remains when total expenses, such as the cost of goods sold, general administrative expenses, interest paid on debt, and taxes are subtracted from total sales. What I've done is I just went to one of the easier to understand financial statements. Target, the retailer, they're straightforward. They're a US-based retailer. They don't have any international operations. There's very few acquisitions. They're pretty much an organic growth type company. That's why it's easy to read their financial information. This documentation is from Target's. You go to Investor Relations, you go to the SEC list, and this is their documentation, pretty straightforward. When they're talking about net income, right here you see net earnings. It could be named net income, and right here. You can see good years and bad years, COVID, no COVID, and then now they're just in this recovery mode and now anticipate these earnings probably to drop even more. You can say that they're flat. In regards to, we're talking about goods and services right up here, cost of sales. So you have your G&A, then you have depreciation. They're all subtracted, and you're going to get this operating income. This will be your EBIT, earnings before interest and taxes. In some cases, you're going to have EBITDA, which you're going to take out the depreciation and amortization. Depends on who and what you're doing. All you're going to do is you can take this 5707. That will be your earnings before interest and taxes. If you want EBITDA, you take this operating income and add back depreciation and amortization. It's kind of foolish for analysts to mess around and think that their operating income is rosier when they add back depreciation and amortization. But in the end, still going to remove depreciation and amortization to get to free cash flow. Earnings before interest, taxes, depreciation, that would be your EBITDA I just explained. EBIT, earnings before interest and tax, is also known as operating profit. Because tax structures and interest expenses vary from company to company, setting interest and taxes aside lets you gauge how much a business earnings from its regular operations. EBIT is a helpful measure when comparing the financial performance of two or more companies. We use EBIT when we're measuring the return on capital. We can also use EBITDA, but we're always removing the D and the A, the depreciation and allowance. Depreciation is an accounting term for spreading out the cost of tangible assets with a lifetime span, such as a piece of equipment, machinery, or technology. From an accounting point of view, it's a made-up number. That in amortization, it's a plug-in. It's one of these deals where the accountants can manipulate this, and they use it as a means to massage the numbers in terms of write-offs. You hear these one-time write-offs. Well, you're going to see that in the amortization component and depreciation. Over the lifetime of that asset, which allows companies to reduce their taxable earnings for multiple years. For example, say that a business owns a car that costs $40,000 and expects it to last for 5 years. The business might deduct $8,000 per year as depreciation expense for the use of the car. Amortization is similar, but is used for allocating the cost of intangible assets, such as trademarks, synergy, you name it. They're going to throw everything in this amortization box. EBITDA can be a useful metric when looking at companies with large cap expense. There are also several financial ratios that can prove helpful for valuing shares and company valuation to that. So we're going to see here your earnings per share right here, $8.96. We have your basic and diluted. The basic would be pre-stock options. You're going to see this 896. And then if you have stock options, which are rights to the executives for the most part, and some employees, you have to take that into consideration. We're going to look at basic earnings per share. Well, we'll look at earnings per share as the measure of a company's profitability per outstanding share of common stock. Common stock shares represent equity ownership in a company. You often see two earnings per share measures at the bottom of an income statement, basic and diluted. Basic earnings per share is computed by dividing a company's net income. This would be this 4138 by, and you have 461 million shares outstanding. You just take this 4138 and divide it by 461 million. You're going to get 896. You have diluted, you're going to do the exact same thing. And you can see there's a 2 cents per share difference. And it doesn't seem like much, but take 462 times 2 cents. And it could be millions and millions of dollars. You can also have multiple classes of share. If that's the case, for example, if a company has net income of 100 million and has 50 million shares of common stock outstanding, the formula to determine earnings per share would be 100 million divided by 50. I thought I'd just point that out to you if you need to read it. A company might also issue preferred shares, a different class of stock that doesn't typically confer voting rights, but often yields higher dividends than common stock. If preferred shares are issued, the amount paid in dividends on these shares is subtracted from net income before dividing by the number of outstanding shares. Diluted is calculated by dividing net income by the common shares outstanding plus the potential number of shares that would be outstanding if such instruments as preferred shares, convertible bonds, stock options, and warrants were exercised. Price earnings ratio, I don't think there's anything here that has that broken down. Keep in mind, this is an annual report on the right here. It's 128 pages. There's a lot of different data on here. And this is where you could start manipulating this information. You can take this price to earnings, whatever that current price is. Right now, Target's selling for $113 a share. We're going to take this price and you're going to divide it by earnings. So you can take 113 divided by 896. A PE ratio can help you compare the valuation of different stocks. It's calculated by dividing the stock price by earnings per share. A stock with a comparatively high PE ratio trades at a higher price relative to its earnings per share than a stock with a lower PE. In other words, it might be relatively expensive with respect to its earnings. A stock price at 100 per share with $5 earnings per share has a PE of 20. Here we have 896, and right now the stock is selling for 113, and you can do the math there, and that's going to be about 1296. Return on equity. Return on equity is a profitability measure that determines by dividing net income divided by common shareholder equity. You go down here to the balance sheet, and you're going to see shareholder investment. They have a different name, but that's the same thing as shareholder equity. And it's 13,432. You're going to divide this net income, this 4138, divide that by, well, you're going to take this 13 and divide it by 4. For example, if a company has a net income of 15 million and a shareholder equity of 100, its ROE would be 15%. Return on equity is another ratio used to compare a company with its industry peers. Industry coverage ratio, this again will go to the debts. We're going to look at their interest expense, which you'd go back up here. So we're going to have this total debt. The interest coverage ratio is a way to measure how difficult it might be for a company to sustain this debt load. It's calculated by dividing EBIT over annual interest expenses, which is the amount a company pays in interest for money it borrows. A company with earnings of 60 million, be careful here because now they're saying earnings. You need to say earnings before interest and taxes and interest expense would have an interest coverage ratio of 3. We use this number. This is a critical number because we have to determine the debt ratio and this coverage. And then we use a couple other different useful measures to come up with various pricing. Based on beta, you determine the risk level and the cost of capital and cost of equity using the ICR. But here you're going to see net interest expense right here, 502. So you're going to look at this 5,707 and divided by 502, and it looks like it's going to be about 9 something, which is favorable. But you have to parse this information, this net interest expense. When you do this, you're going to have to do a little bit of reading to understand what the different components are. Then you have your operating margin. Operating margin is determined by dividing EBIT. Remember what EBIT is? That's your operating income. By total revenue. It shows how much income is generated by each dollar of sales. It's a way of comparing the profitability of different companies without having to adjust for different. A company with 100 million of EBIT and revenues of 500 million would have an operating margin of 20%. As with most financial performance metrics, operating margin is best used when comparing a firm's performance with its peers. Comment, let me know if you have any questions, concerns related to these metrics. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.